Hello everyone, hope you all are doing great. Some days ago, I came across this paper about the government interest rate decision and the impact of it on individual investment decisions regarding the assets or fund allocations. I mean, in simple words, like how much they allocate for safer options like fixed deposit, RD, etc., and how much they invest in the comparatively riskier places like stocks, SIP, etc. So, I thought to make a video about it. Tada! I'll provide the paper's soft copy link in the description below. If anyone fancy, please have a look through it. Basically, it's just a behavioral finance. I mean, how people as an individual and institution will behave in both high interest rate and low interest rate environment. This experiment was conducted in US in 2017 and in a moment we'll see who are all the participants. It was conducted and presented by 3 students from top reputed business schools such as MIT, Chicago Booth Business School and Harvard University. Anyway, enough of this chit chat about it. Let's get into the video. Please have a look at this bar chart. If required, please pause it. These are the percentages who owns it and how much percent owns in the top 1000 Indian companies in the Indian stocks by market cap. So approximately 50% of the companies owned by the promoters, the remaining 50% owned by relatively liquid institutions such as FIA and DIA or the individuals. Thus, it's important to understand their behaviors. Just for info, in 2020, foreign portfolio investors used to own over 20%. Now, in September 2022, that was reduced to 17%. Individuals and mutual funds together accounts for near 18%, which roughly we can say it's retail people. Since we give the money to mutual funds through various entities like SIP, etc. Regarding SIP, at present it's over 16% of assets in mutual fund. Earlier it used to be less than 12% in 2020. Now coming to the experiment, basically they try to find answers for 3 questions, but I feel the third question is too technical and not that much important. So I just thought to concentrate on just first 2 questions. First, how much the history will influence on fund allocation? I mean, when the Reserve Bank doing the transition from higher interest rate period to lower interest rate period and from lower interest rate period to higher interest rate period. Then the second question they want to answer is how much new funds will be allocated if the government or the Reserve Bank increases the interest rate like 5, 10 and up to 15%. Now regarding the experiment participants, they considered and they took 3 groups to represent the various entities in the stock market. Here I'm not using the same technical names what they referred in the paper. Just for understanding, I'm classifying them as simple in our known English. First, Group A, 400 general public to represent the general overall populations. Then the second, Group B, 400 people to represent the retail investors who got some financial knowledge. Then the third, Group C, 400 students from Harvard Business School to represent the institutions like FIA and DIA, etc. They did follow all the required statistical approach to make sure the results to represent the real world environment. And they did present the explanation in the paper regarding their approach. I don't want to go in detail about how and what they did it since it's very boring, so let's go straight into the answers. How much the history will influence on fund allocation? Here, lower interest rate means 1% and higher interest rate means 5%. Now let's have a look at the results chart. Here, hypothetical represents general public, Group A. Then incentivized represents investors, Group B and C. And in both hypothetical and incentivized, they further divide that into 2 more scenarios. As I said earlier, Group 1 transition from lower interest rate period to higher interest rate period. Then Group 2 transition from higher interest rate period to lower interest rate period. And as we all know, the present situation is from lower interest rate to higher interest rate, which means Group 1. So we just concentrate on that. In terms of general public, earlier during low interest rate period, they allocated 56% of the funds to stocks and SIP, etc. Whereas now in the higher interest rate period, that allocation will drop by 9% to 47%. Then in case of institutional and investors, they used to allocate near 63% and now that will reduce by 7.5% to 55.5%. I hope you guys understood. If required, please pause it and have a look. Now coming to the second question, it's not complicated as first one, it's more of the straightforward. How much new funds will be allocated if the government or the Reserve Bank increases the interest rate like 5, 10 and up to 15%? Again, have a look at this graph. If interest rate is 1%, which was the earlier US situation in 2021, then as an average, 65% funds will be allocated to equity and equity related investments. If the government increase the interest rate to 5%, then the allocation drops by 8% and roughly to 57%. If they further increase the interest rate means like 10 and 15%, then the people fund allocation will drop further and will kind of hits the plateau of at least 50% allocation. So that's it. As a summary, based on these two questions, it shows that the new fund allocation only dropped by as an average of 7%. For example, if we take SIP, every month on average, mutual funds getting the SIP new money approximately of over 12,000 crore rupees. Based on this experiment, in worst case, mutual funds will still receive at least 11,000 crore rupees every month. And that's what saved the Indian equity market in 2022, even when FIA take out over 3% of their investment. I hope the information is interesting and useful. Please let me know in the comment section if you guys like this kind of behavioral finance so I can try to search the similar kind of information. That's all in this video. Please consider subscribing the channel and liking the video. Thanks for watching.